So hello everyone. Today we have come out with the market outlook for the month of November. We have seen that in the month of October towards the end, the markets again reverted back. The markets which had fallen actually because of the surprise interest rate hike news in US, because previously there was an expectation that interest rates will be around 3.5% by December 2022 ending. So that was hiked to 4.4%. And we declined, the Nifty declined from 18,000 to 17,000 because of that. But now, again, the markets have recovered. So let us see, what can happen going forward in the Indian markets, and also taking clue actually from the global markets, because globally the things are looking, more on the lower side when inflation is higher and we are seeing some sign of recession actually in the outside world. Now, if you see one of the recent step taken actually is having a very high weight in dollar index. So when euro falls, dollar actually moves up because 58% weight euro has in dollar index. So recently, because of this interest rate increase in euro, it looks like, or in Europe, it looks like that there may be a topping out scenario, at least in the short term, for dollar, that can actually provide some relief to the emerging markets. So this recovery can sustain at least for 1 or 2 months now. Now, if you see in Europe, when we were talking about a slowdown scenario, a recessionary scenario, we also were talking about that in the winter session or season going forward, there will be, there may be an energy crisis, because Russian supply had diminished, significantly from 40% to 10%. So it looked like actually how the things will proceed. Now, if you see the Europe or European Union, they have built up the capacities up to 95%. In Germany alone, we have seen the capacities are built up to 98%. And that is the reason the energy prices also actually have declined. So it was almost 75 euros. It declined to, has now declined to closer to 30, 33 euros now. So the prices have come down, but yes, previously we had seen the prices very low in 2020 or before. So relative to that, it is still higher, but yes, it has come off from the higher levels. So all of this indicates that going forward, what problem we felt that can come in November, December, or to some extent of January, our sense is that this problem may not be there. The markets can find some relief now because of this. Dollar positioning has to be seen, but if euro stop falling further, we may see that dollar also may get top out possibly in the near term. So coming to the interest rates in US, because this was a surprising element, if you look at this particular green line and you look at this mean, now it is increased to almost 4.4, 4.5%. Previously, it was 3.5%. So this is where Nifty had also declined from 18,000 to 17,000. Now, this is the expectation up to 2022 ending. So we have only one meeting left in US. And if you see the interest rates here, so they are already up to 4%. So from 4 to 4.4 or 4.5, that means another 50 bips of rate hike is expected in the month of December. And this is what market has discounted. If it is going to be a higher increase, then markets will again start getting nervous. So obviously, very high interest rate surge continuously may not be taken positive by the markets. But right now, we have already seen, these consecutive 75 bips of rate hikes in US. I think the 4 hikes we have already seen. And the bond yields, they move up much faster. So US bond yields had moved to 4% actually before, and now it is 4.15%. So for the month of December, this is what the market expectation is. Now, if you see the UK, because UK markets had created a lot of volatility, there was political instability we saw in UK, and the bond yields in UK had moved up very sharply. You can see this pattern here. Now with the new Prime Minister coming in, and there seems to be some stability there, though the problems may remain intact, the core problems may remain intact. It has to be fought by the new team now over there. But the bond yields actually have cooled off from what it was actually before. So it looks like there may be some consolidation here possible that can also provide some comfort to the equity markets for another 1 or 2 months perspective. Now, when I look at the Indian markets on a fundamental grounds, obviously the things are not that much positive what it was before, because if you look at the macros, the CAD was low, current account deficit was low, and now we are expecting that financial year 23 may have 3% of current account deficit. Forex cover previously was very high. It was 16-month cover when we had a Forex reserve of $640 billion. Now this Forex cover actually has come down. It has come down to almost $530 billion. So it is an 8-month cover now. Earnings were very strong. Previously, we saw that Nifty EPS was growing by 18-20%, but now it is growing by 12-14%. So that has moderated from the pace what we were seeing before, and you have seen it that Nifty also has been consolidating more. Time correction is there. So I think that phase may continue for a while. If you see liquidity perspective, so obviously previously we had a lot of liquidity, but now slowly it is going off because of the interest rate increase. In US, there has been $95 billion of bond, no fresh stimulus is there. So slowly they are, trimming this particular position. And that is also, sucking the liquidity from the markets slowly. Now, if you see the valuations perspective, previously the market cap was 75% to GDP, but now the market cap is almost 110% of GDP. Our GDP is around $3.17 trillion and the market cap is around $3.5 trillion. So overall, it looks like that from the valuation perspective, markets are not that much cheap, but overall ground, it seems the resilience that Indian markets have shown is quite remarkable. And we have few reasons to believe that this optimistic scenario, you can say it is, you may be cautiously optimistic, but at least you cannot be negative on the Indian markets here. So there are certain reasons for that. If you see, one of the biggest reason is that India has started taking the discounted crude oil from Russia. In March 2022, its share was hardly 0.2%. Now it has reached to 23% in the month of September. So you can see how the Russian supply of crude to India has increased actually very, very sharply in the recent period. And we are also seeing the deals happening in rupee also. So that is another push for India, whether you are dealing with Iraq. Iraq also has become one of the largest. Saudi has gone to, I think, 3rd place, which was the largest before. So with Iraq and Russia, India has a proposition of doing some trades in rupee also, which I think can benefit India going forward in the long run. The other reason of resilience for the Indian markets, if you see the bond yields in India, so 10-year GSEC yield has remained almost flat in the last 1 year. In between, you have seen that the repo rate increased from almost 4.4% to 4.9%. So almost 150 bips of jump we saw in the repo rate, but bond yields have remained quite flat. In US, rather, we have seen a very sharp move. So last year, it was the same period when our yields were 7.5%. The US yields were around 2.8%. Now they have moved to 4% plus, and our yields are still below 7.5%. So that is another reason of resilience for the Indian markets, Indian equity markets, because our bond yields, whatever level they had moved up, they have discounted the further rate hikes. And then afterwards, we saw that our inflation broadly remained under control. The many commodity prices, for example, palm oil prices had declined very fast. So that controlled the food inflation area also. And then crude oil also declined. And we saw that our inflation remained mostly under this control. And another thing, if you look at the real rates, Indian rates were positive before. Now it is 1% negative. But in US, it is 4% negative, or in fact, more than that. So that is another reason why Indian markets, the bond yields have not surged that much, and we have remained mostly resilient in this particular period, vis-a-vis you compare with developed markets or you compare with some of the emerging markets. Another reason of resilience for Indian markets has been the EPS growth, because previously this growth was very sharp when we compared with the previous decade. There was a clear breakout of earnings. We were growing with 18-20%. Now we are growing with 12-14%. So 720 rupees of EPS of financial year 22 likely to grow by 14% to 820 for financial year 23 and possibly 934 for financial year 24. There may be ups and downs in this particular figure because of some of the volatility which can come, but broadly markets are the EPS is still growing in India, and our GDP growth is also sticking around 6-7%. So that gives an encouragement that this resilience actually can continue now, even from these levels. If you see one of the major component for Nifty, banking, which has come up very nicely in the recent period, the credit growth in the banking domain, if you see, it has gone to almost 128 plus lakh crores, and the credit growth actually has come to 18%. The total credit is around 128.6 lakh crores. So there has been a very sharp move in the jump in the credit actually. And if you see the EPS, because of this, because some of the provisions which were done before, they have been written back. We have seen the PAT growth has been very sharp in the banking domain, whether it is private or the PSU players. And you can see here from financial year 19 till 24, there is an expectation that 28% of CAGR growth will be there. So we have this another 2 quarters of financial year 23 and then the whole financial year 24. So obviously the banks are likely to do better on this premise that their earnings growth is good, and that is leading to a good growth in earnings of Nifty also. From when I talk about the credit growth in banks, if you see the retail as well as corporate, both the segments are seeing a reversal on the positive side, so which is good, encouraging. In the retail side, housing loans have picked up really nicely. In the corporate side, we have seen that even the SME has come back, and there is a good demand which is coming from the SME. Government impetus on manufacturing, the recent capex which is coming out, all of this is leading to this particular growth. And we believe that ultimately this 18-17% of credit growth is going to surpass 20% also going forward. Now, going forward, one challenge that banks can face is when the credit growth will go very fast, you need to fund the growth. And for funding, you need extra money. So you need deposits. So you can borrow at a higher rate. So in that case, you need to be a little careful. We believe it is always better to be there with the larger banks, because smaller banks' valuations can be challenged when NIMs, which are expanding right now, can start getting shrunk a little because of the higher deposit rates or higher borrowing rates, etc., to fund this credit growth. So that is something is really watchful going forward, but that may take, we believe, another couple of quarters. But by that time, the bank should remain fine. So this is the investment cycle in India. If you see it had come down to the trough. Now, 26% of GDP we had seen before in 2002-3 period, that when it declined to that level, then we saw the capex cycle started. So this is almost the trough of this particular investment cycle. And in 2021 ending, we saw that again market in India, it was hitting the same 26% kind of levels of as a percentage of GDP. So it was likely to improve, and it has improved actually. So if you see the capex, state and center, obviously it was there, but the private capex also from 5.2 to 6.5 lakh crores, it is likely to be there. So total, this is the extra 21 trillion rupees of capex which is expected actually now. So this is encouraging, and there are various sectors where we are seeing this capex coming in, whether it is metals, whether it is cement, whether it is chemicals, and now we are seeing in renewables also, the capex is happening. The companies are looking to set up more EV plants, electric vehicle plants actually going forward. We are seeing data centers actually getting opened in India. We are likely to see, because of the robustness of the orders in defense also going forward, there will be capex. In electronics manufacturing, India has the upper hand now. The number of mobile phones which we were importing, so we were importing almost 90% of mobile phones before as per our requirement, whatever we are using, but now 97% are being manufactured in India. So this is a great jump. iPhone 14, actually, when it was launched, within a couple of weeks, it started getting manufactured in India. So many MNCs are also coming back, and they are doing a lot of capex. Another thing is, because in Europe, the energy prices are still, though they have come out from the higher levels, but still there is a crisis. And we have seen that some of the MNCs, they had to shut down their operations there, some plants over there. So if they are part of India, if they are active in India, and with the government support, they will likely to get or to enhance their capex actually more in Indian markets, because ultimately they have to maintain the consolidated balance sheet across the world actually better. So that is one Europe plus one kind of thing that we have started, or the market has started talking about, which is benefiting some of these companies. From the consumption front, because our per capita GDP now is around $2,300. Now, if you see in the formal sector, the wage growth has been very robust. You are seeing this wage growth can support the real estate market. We are already seeing good registrations happening. And there is going to be push for other discretionary consumption also. So you have seen that how from 2021 to 22, in that particular period, it has seen a very sharp move. So that is how I think the discretionary expenditure can see a revival. We are already seeing in automobile that growth is coming back. Automobile was under pressure for 5 years, but now if you see the October numbers, we have seen even in the passenger vehicle segment, there has been a good growth. And then if you see the other segments like, a washing machine, refrigerators, so there also we have seen a good festive demand coming back, though the pressure is there on margins because the high cost inventory has taken, this particular quarter to go off. For H2 financial year 23, we believe the margins in these companies will become better. Now, if you see the consumption trend in refrigerator or washing machine or room ACs, if you see in Asia particularly, it is up to a very high level. Particularly in refrigerator, it is 58%. In India, it is 35%. There is a lot of room to capture. In washing machine, it is 41%. In India, it is 15%. In room ACs, it is 38%. In India, it is 6%. So there is a very good catch-up which can come with the growth of consumption in India in these segments. And another thing, we are seeing a premiumization actually of these trends also coming up. For example, in fan, if you see fans have almost 80% or 85% of penetration in India. Now there is a premium fan kind of concept which is coming in. So these premium fans now have 20% of the industry versus 6-7% just 3 or 4 years back. The other segments like room ACs, you see inverter ACs now account for 60% of overall industry. while in financial year 16, it was lesser than 10%. Washing machines, now fully automatic washing machines, they comprise of 40% of the industry volumes right now. Vis-a-vis, it was 30% actually in 2000. Now, if you see, industry is moving towards frost-free refrigerators. So all of these things, they talk about a premiumization and the trend. Now, you need to understand one thing here, that we saw more luxury goods performing. We saw that the SUV as a segment in automobile performing. We saw that, you know, some of the jewelry segment performing well. So the luxury segments were doing better. Even in the Eicher Motors, we have seen that the number of sales has been much better in the RE segment, Royal Enfield segment, though they have come out with a new vehicle also at a relatively competitive price in 350cc segment. But overall, the move in India, which was very clearly seen, it was towards the luxury segment. We believe going forward, there may be some more traction towards the rural area also, or the tier 2, tier 3 cities also. If you see, one of the major reasons for this, I think the harvesting for Kharif is already there. But going forward, Rabi crop also can be much better, because the reservoir level, the water reservoir levels in India are almost 90%. If you see the last 10-year trend, it is 76 or 77%. So that can lead to a better crop actually going forward, and which can drive the consumption linked to the masses also to some extent. So for example, we have the PV sales here, the passenger vehicle sales here, which has come up good in the month of October. And Maruti, which was the laggard, if you can see here, it has posted almost 29% of jump. So this is a good growth actually on year-on-year basis, one of the best in Maruti in the recent period. Margins have also improved because of the lower steel prices. And it looks like, because commodity prices are lower, the margins actually can improve further in H2 financial year 23. So passenger vehicle across the board, we have seen improvement. Mahindra, on whatever base it is, it has given 60% of jump. Tata Motors also 33. But Tata Motors, the domestic, the JLR numbers, you know, are more dominating one that we have to see. So all depends how China is opening up, how the global markets are seeing recovery. But the core domestic players like Maruti and all, or Mahindra, they have started doing better. Real estate, as we discussed, we have seen one of the record high registrations in Mumbai. And if you see the real estate market, it had made almost the bottom actually in terms of growth. And now this growth is coming back. So generally, we have seen 8 years or 10 years of either lull cycle or the pickup in cycle. So if you observe here, this was continuously down from 2012 onwards. So we have seen 10 years of lull cycle in real estate. And now it looks that it is recovering. So if it starts recovering, then this cycle can continue for 8 years also going forward. And it's a very long period in which you can see growth in many segments linked to real estate. So there are segments like building materials, you know, or cement, or many other spaces in commodities also, which get benefit because of the higher housing sales, etc. So recently we have seen 5G rollout. We have seen Bharti, Jio, they participated in the auction, and then finally they are going to the Pan India launch. If you see Reliance Jio, by December they are going to do the Pan India launch most likely, and they are already now going to be in Delhi, Mumbai, Kolkata, Chennai. At least they want to cover key cities initially and then expand more. Bharti Airtel also, by March 2024, they are going to be more broad. And we have to, ultimately, the canvas is ready now for these companies to start rolling out 5G. So 5G rollout is just not something which is good for them. So it is good for many industries actually, because you will see a game change in terms of data uses, in terms of fast data coverage, and ultimately that will lead to a lot of innovations actually going forward. And you will see many technologies which were just coming at the door of India, they will also enter, and with the use of 5G now. So this is a real growth in certain sectors you will see going ahead. Domestically, GST collections have remained robust. So we have seen almost 8 months now above 1.4 lakh crore of GST numbers. In fact, this October it has been 1.52 lakh crores. So very encouraging numbers from GST. And the government also for financial year 23 is meeting the target for a fiscal deficit. In fact, it will not broaden because they have not increased the borrowing, rather they have decreased the borrowing by 10,000 crores actually now. So lastly, if I have to look at the performance or outperformance of India over the other markets, we believe it is likely to continue. Now, if you see in MSCI index, India weight has increased from 7.7% in March 2020 to now 14.1% in September 2022. It is just next to China. Now it can go to 17% if Korea is moved into the developed markets by MSCI, just following the step of what FTSE has done. So this is something that we need to watch, along with some other triggers like HDFC Limited, HDFC Bank merger can also will also open 8 to 9% of room for FIIs to invest in HDFC Bank, so that can become part of MSCI. So all of these things are there going forward, but it is definitely on the cards that India weight can increase further in MSCI. So whenever dollar starts getting top out, we will see that some of the flows can start coming in from FIIs in this consolidation, and that can bring, that can be more beneficial for India because the flows can be higher. India is well placed in terms of real rates. This we have discussed. India inflation by March 2023, it looks like it can be 6% or possibly lower also going forward. So that is where Indian resilience actually is there, and vis-a-vis the other outside markets. Our premium, generally people talk about that the valuation premiums are much higher in India. So yes, it was 40% historically, now it has increased to 86%. On a 1 year basis, it looks costly, but if you look at the 4 or 5 years perspective, because of the EPS growth which has continued in India, it looks cheap. Because in the outside world, like for example, take the case of S&P. If S&P price to earning is 16 times, and if the EPS growth is not high going forward, then obviously the price to earning, can go to 20 or 21 times also. But India price to earning, which is 19 times, can go down to 16, 17 times also if the EPS growth continues in this particular time correction of the markets. So looking at the longer perspective, India looks definitely cheap. If you see the domestic investors rescue when FIs are selling, that has continued from October 2021 till June 2022. FIIs have sold 2,55,879 crores, while DIIs have bought 1,90,558 crores. So this is really a major supporting factor for India, and it is likely to continue. Looking at the flows, the SIP flows in India, the number of demat accounts which are opening up. So overall, the context is there that Indian outperformance is likely to be there over the other markets. Lastly, I will tell you one important point for the people who are looking for little short-term trades. See, if you clearly see Nifty future premium vis-a-vis discount over Nifty spot. So when Nifty was around 17,000, we saw there was a discount in Nifty futures, and so Nifty moved up from there on the back of short covering, and now this premium, it has come into premium. So this premium can expand further for another 1 or 2 months, and then again market can stuck up in a range. This is what we are seeing for the last 6-7 months now. In the month of February, March also, we had a discount. And from there, market moved up. When market moved up, then again, we saw the premium coming back. And then again, market got stuck in the range. And then again, we saw this in the month of May, there was a discount. And finally, in the month of July, market again started moving up. And then near 17,000 in the first half of October, rather, we saw that discount again came up, and you saw what happened. Nifty again moved up, and now this is coming into premium. So there may be some sustainability, but again, markets can again go into a range. So that is how the markets are shaping up. New themes are coming up where we can focus more. Like, for example, we have seen the automobile pack has come back in the recent period. So that may be the focus area. Some of the capital goods companies are doing much better. Their order book is surging. So that is again the focus area, along with the banks, where the profitability is rising, what we discussed in this presentation. So that's all from our side, from the market's perspective for the month of November. So that is all. Thank you very much.